Good morning, ladies and gentlemen, and welcome to the QVG Capital September Investor Webinar. My name's James Marley. I'm a co-founder of Livewire Markets, and I'll be hosting the webinar today. I'm joined on the line by QVG Capital's principals and portfolio managers, Chris Prunty and Tony Waters. Also on the line is Josh Clark, who is portfolio manager of the QVG Capital Long Short Fund. The agenda for today is up on the slide in front of you, and Tony, Chris and Josh will be providing an update on performance, some reporting season observations, and update on the two QVG Capital funds, the Long Short Fund and the Opportunities Fund. We have also set aside time for an interactive Q&A session at the end of the webinar. If you have a question, you can submit that via the Q&A toggle at the bottom of your screen. We have also received a question in advance, so we're committed to making time to answer all of your questions today. So thank you very much for joining the webinar, and I'll hand over to you, Tony, to get things started.
Great, thanks, James, and good morning, everybody, and welcome to the QVG Capital webinar. This is the second time we've done this. I feel it's a great way to be able to communicate with you, our investors, so much so that we're going to make this a biannual event. So hopefully something you can look forward to each March and September. We did listen to your feedback first time round, and we have allowed more time for Q&A today. So hopefully we'll get through most of your questions. And without further ado, I should introduce also Chris Prunty, my fellow co-founder and investment principal, who will talk about some of the opportunities we're seeing in the aptly named Opportunities Fund, and of course, Josh Clark, who many of you will know as our Long Short Fund Manager. So on to the next slide, and this is an important slide to start off with, is what do we stand for? If we can convey this well to you as our investors, it's more likely you'll stay with us, stay the course, and over the long term we can make a positive material difference to your investment performance. For us, the game's not necessarily about who's the smartest in the room or even who does the most work. In fact, with funds management, it's often being grounded in understanding what you don't know is often more important than understanding what you do know. Rather, for us, it's really about the principles in which we stand for and the culture and the structure to be able to provide long-term sustainable performance for our investor. So, firstly, we buy quality growth companies at fair prices. What's quality for us? I mean, quality for us is about companies that can sustainably compound their earnings. And we look through value in exactly the same way. We'll rank companies on that basis. So, rather than value being about low PEs and high dividend yields, if you look at those companies, for us, typically, I'll show you a structurally challenged business, often with high gearing. And while not necessarily a bad thing to have a high payout ratio, it often means that they can't find good use for those funds to deploy back into the business and reinvest at high rates of return. So quality is good management, good product, good services, is a definition of quality. It doesn't matter anything unless you get that compound earnings growth in the business. So that's the definition of quality. Secondly, we're aligned. Myself and Chris were the first investors in the Opportunities Fund, and we have reinvested since. And it's important that we share the highs and lows with our fellow investors, and we go along that journey with you. And we still remain one of the largest investors in the fund today. And of course, we have a passion for what we do. I've been analysing small cap companies since the late 90s, Chris not long thereafter. And, running money professionally on behalf of other investors, we've now done that for well over a decade. We couldn't have done that, I don't think, unless we have a passion for what we do. And that passion means sustainability in the team and sustainability in performance. And even Josh, who's been with us in various forms for, I think, around 7+ years now as fund manager of our Long Short Fund, very much shares that passion. And finally, we strive for constant improvement. Doesn't mean to say we change our process. That's sacrosanct as far as we're concerned, but it does mean that we need to be abreast of market changes. So think back 20 years ago when I started. The market was dominated by a handful of large institutions, That's very different now. You know, the rise of index funds and ETFs with the amount of passive money in the market, the reduction in brokerage fees means high turnover strategies, momentum-based strategies, quantitative-based strategies, and the ability to short in the market, even through the small cap space, means the way the market reacts to news flow is very different to what it has in the past. And we need to be abreast of that and have good strategies to execute our long-term investment positions. Likewise, information flows in a digital age is vastly improved to what we had in the past, and we need to be abreast of that also. So on to the next slide. And this is our performance. It's nice to be able to talk to you coming off one of our best reporting seasons ever. That was great. But I should stress to you that won't always be the case. For those of you who have been reading our monthly newsletters, you'll notice our top 5 positions actually hasn't changed a lot. It didn't hold us in good stead late last year when the reopening trade was on. But, you know, this is about being disciplined to our process, sticking the course and holding those positions because we had faith in those positions to be able to deliver for us over the longer term. And that's really held us in good stead over the last 3 to 4 months. And from our point of view, you know, really highlights also the fallacy of trying to chase short-term trends in the market, which is where most of the news flow that you read day to day in the financial press is all about. Consistency of performance is really what's more important in this chart, and short-term performance, of course. It's worth noting, you know, myself and Chris, we've been running money for well over a decade. Of the 11 years, full years we've been running money, we've outperformed the market in 10 of those 11 years, including 4 out of 4 since we started QVG, albeit 2018 was line ball. And it's really that consistency of performance where we can compound those earnings and grow that over the long period of time is what counts. And of course, long short there, I mean, that's actually been better to date than Opportunities Fund in what's been pretty much a bull market during its existence, which has proven that Josh has been able to add value on both the short side as well as the long side, which really goes to the process extended to a long short capacity. And Josh will talk more about that in a minute or two. On to the next slide. I'm going to preempt some questions that'll likely come in terms of capacity. Many of you know it gets harder to perform at the same level as we get larger in fund size. We're acutely aware of that. For that very reason, we soft closed the fund, as many of you recall, back in our first year of operation. And while we've grown in the Opportunities Fund to now well over 700 million, you can see from this chart that most of that has occurred through performance rather than inflow. In fact, inflow has hardly changed over that period of time. It's also worth noting that the ASX 300 entry in terms of the market size overall has increased from a bit over 500 million, being the median sized company, going to the ASX 300 to now 1.6 billion in the last changes. And that's a massive difference in the market, not just through market performance, but also the amount of new issues that have come to market means that the sand pit, if I can call it that, in which we're playing in, has increased substantially over the 4 years of QVG's existence. On to the next slide. This is my favourite slide, actually. And what I want to impress here is this is really a true to label side. I mean, we talked about looking for companies that can deliver sustainable compound earnings growth. And so these are the financial metrics that we focus on to be able to find those companies. If we consistently do what we say, we should have a portfolio where the return on equity in our portfolio company is far greater than the market as a whole. The balance sheet, meaning plenty of capacity in which to deploy capital at high rates of return, is much better than the market overall with gearing, and that's always been the case. And a combination of the two should mean better revenue growth in our portfolio company than the market overall. And if we're only paying a slight premium for those metrics, then this is our sleep at night chart where we're very confident that we can outperform over a long period of time as long as we stick true and make sure our portfolio beats the market on these important metrics. So on to the next slide. I'm going to give you a bit of a flavour, given we've just come out of the August reporting season, in terms of what we're seeing in the market right now. And a couple points to make on this slide. First of all, we see the markets getting back into what I consider normal market conditions. The ratio of upgrades to downgrades is getting back into a normal pattern to what we've seen before. And that's coming off a very unnormal year with the onset of COVID, and where the market behaved quite differently to where analysts had predicted at that point in time. Some of you would think is why the market hasn't traded even further downgrades. It's worth making a couple of points here. First of all, the market's always looking 1 to 2 years ahead. So, even though we've got our largest 2 cities in lockdown and have for a few months now, the market's looking where we're going to be in 22 and 2023, and looking at where earnings are going to be on that basis. Secondly, a lot of small caps, certainly a lot more now than what was the case 10 or 15 years ago, have a good portion of their earnings offshore. Certainly for our fund, there's at least half our constituent companies have significant offshore earnings, and we have seen quite a drop in the Aussie dollar of late, particularly with iron ore prices as one example, having come back significantly. And so that's helped the translation of offshore earnings into Aussie dollars. On to the next slide. So this is a chart that you probably have seen before, and what this chart depicts is where consensus earnings are early in the forecast period and where they end up. And this is a good example where sell side or broking analysts typically over predict company earnings. And again, what we're getting back to a normal pattern where the issue is, I think, is we came through a year where analysts extrapolated a year which was significantly enhanced or juiced by stimulus, and we had a significant diversion of spending patterns, particularly in consumer-facing stocks. And we're getting back to what we think will be a normal environment as we're getting through the end of the pandemic. So what I would suggest here is that trend downwards in terms of earnings revision will continue. It doesn't make sense to me that currently we've got FY22 earnings forecast growth of 14.5% when we've still got interest rates on emergency settings. Either interest rates have to come up significantly, or we're going to see further downward trend in earnings. Given the way it's going, I think its downward trend in earnings will continue into the future. So on to the next slide. Having said that, the next correction won't come by a credit crisis amongst Aussie corporates. In fact, balance sheets are still in great shape by Aussie corporates, and you're seeing it lead to some interesting activity at the moment, particularly on merger and acquisition side is becoming enhanced. And I think you also see a heightened period of buybacks and probably increased dividend payout ratio, which is good for the investors that are looking for an income yield. The other point to make is on the onset of the pandemic, there was a race to capital raisings in the market, which has also helped the balance sheet position now. Effectively, if you're an ASX 300 company, you do have somewhat of an insolvent immunity, if I can call it that, because of the amount of passive money in the market. Just to maintain their market weight, they will automatically participate in those capital raisings. And that did occur amongst a lot of companies on the onset of the pandemic. On to the next slide. So, and again, another preemption on the question on, is the market expensive or is the market cheap? A few relevant points that I'd like to make here. First of all, if you're looking at it through a PE multiple prism, then absolutely the market is crazy expensive. It's continued to be on record highs from a PE ratio point of view and has been for some time. And in fact, you would consider the market, based on historical standards, to have been expensive from 2012 onwards. If you had have taken that approach, however, that would have been significantly costly to you as an equity investor, given what's happened in the market since. So for a better perspective, if we go to the next slide, this trumps everything from my perspective. I'm using a US dollar 10-year bond yield chart here, but an Aussie dollar 10-year bond yield chart would be similar. And, you know, US being relative, given it's most of the global equity, still over 50% of the market. You know, and when you've gone from 14.5% down to 1.3% today, that's been overwhelmingly the reason why equities have done so well over the last 30 to 40 years. So we parlay that onto the next slide. What's really important is a relative value of equities versus other asset classes. So again, in this case, bonds, and I'm using an Aussie dollar 10-year bond example here. And the key point to make here is, since that 2012 period where it looked expensive from a PE point of view, it's actually trading a pretty narrow band on an equity risk premium relative to Aussie dollar bonds. So it's been very much in that 4.5% to 6% band range, pretty much from 2012 onwards, other than a couple of key risk off examples, you know, obviously pandemic being one, and we started in 2012 coming out of that Club Med or Greek crisis specifically in Europe. And where do we sit today? We sit right in the middle of that range. So I wouldn't consider the market either cheap or expensive. A word of warning, however, is when you've got interest rates at such a low position, just pure maths would tell you that small changes in that rate can have a significant knock-on effect to the capitalisation rate of earnings and a potential correction. So maybe that's a good way to end on that thought. It's nice that we have a long-short fund to be able to cater for that type of scenario. And without further ado, I'll introduce you to Josh Clark, and he can talk you a bit more about our long-short product. Thanks, Josh.
Thanks for the segue, Tony. Yeah, so I'll just spend a few minutes talking about our long-short fund. And this slide here, I know a few of our investors will be familiar with, but many of you won't. And I think it's just worth touching on, because I really think about this as our thesis in pictures, if you will, as to why we have a long-short fund, why we see it as long-term wealth creation vehicle, and why I have all of my liquid net worth invested in the fund. And just to explain the thinking, if you just start with that dark blue small cap bubble, you can see that's where the QVG Opportunities Fund has its niche. That's where that fund and also the team has a successful and tenured track record. But a few years ago, we really sat down and thought, what would it look like if we just started unlocking new areas of opportunity in the market for us? Would that provide incremental sources of return? So the other way to ponder on that question is, what would it look like if we just took the very best of our small cap ideas, but then also cherry picked the best ideas we could find in the mid cap space? Also on a very stock specific bottom up basis, added in the large cap ideas that made sense to us. And then over and above that, gave ourselves the ability to profit from companies with declining value through short selling. So the idea was add more tools to the tool belt and essentially give ourselves more ways to win. And then just on the next slide, admittedly, we've stolen this one from fundmonitors.com, but just to interpret it, where the red dot, the blue dots are our long short peer set as defined by Fund Monitors. And I think the reason this is worth talking to is it's just the most concise description of what the journey has looked like to date. So the fund we've been running for around 2.5 years, so it's still a toddler to us, and being proud parents, we think it's got a long and bright future ahead of it. But I think the points to make here are just around the standard deviation or the volatility of returns that we've seen in the fund to date. And one of the key inputs to the volatility of returns is probably also one of the key advantages of a long short fund, which is positioning or how hard we swing the bat. So in a long short fund, one of the unique aspects that we have is we get to decide how hard we can swing the bat in the long book and the short book. It's not capital constrained. And to try and just put that in a simple example, if you have a long only fund that stands to make, say, $1 of profit from its long ideas, our long book within the long short fund, given its positioning, would stand to make $1.20 from those same short ideas, same long ideas, just because of that positioning. And that's before you stop to consider that we also have a short book at play that's an incremental source of return and has produced positive absolute returns since inception for the fund. And then, yeah, that probably just ties into the last point around volatility, which is, you can see that we're about roughly halfway or mid-pack, if you will, in the peer set in terms of that volatility. So the way we describe that is that we've employed only modest leverage to produce the returns that the fund has seen to date. And then just on the next slide, this one I hope you find interesting. We certainly do. These are the stocks that have just come into the top 300 index on Friday. So these are the stocks that have come into the hitting zone, if you will, both on the long and the short side. And what really stands out is the majority of these companies don't make money. And then the majority of those companies that are losing money don't even have revenue. So despite these companies having $2 billion market caps and obviously a lot of inherent optimism in those valuations, they're still very early stage in terms of proving their business model and proving their execution. And one thing that we know, I guess, through probability and statistics, but also just through experience, is if you take a basket of companies with very optimistic assumptions in their valuation, where that basket of companies also lose money, if you were to short sell that basket, then you really skew the odds in your favour, and over a long enough time horizon, you're very likely to make money. So that's just trying to give you a bit of a feel for the opportunity that's out there and coming across our desk even very recently. And with the amount of opportunity that we're seeing out there, the way I'd expect that to manifest itself in the portfolio is I expect we'll see a larger short book. So the size of that short book will increase as we start to add some of those ideas and also with higher conviction, add them with larger weights. And that will have the impact of bringing the net exposure of the fund down and increasing the gross exposure. And then just to try and give you a bit of an example of what's in the short book on the next slide, AGL is one that really fits the mold. So this is really what we're looking for and trying to fill the short book full of. So just at a bit of a high level, the reason it ticks the boxes for us, and also maybe a slight bit of background, the proliferation of renewables has added supply to the wholesale electricity market, brought down wholesale prices, and that also brings down AGL's earnings. So thinking about AGL from a high level, we have earnings declining to a permanently lower base. We've got a capital intensive business, so the cash flows that it produces can't necessarily improve the balance sheet. They're largely having to be reinvested in that capital base within the business. And then on that balance sheet, AGL has quite a leveraged balance sheet, both now and in the past. So actually probably the last little box that AGL ticks is that the scenario that AGL found itself in with these headwinds was broadly beyond the control of management. So there weren't too many rabbits that could be pulled out of the hat to change the trajectory for AGL. And then just maybe a little bit on the journey, you can see that we've added to the position throughout the journey. And I think there's a couple of points to make there. One, it's not a case of let's go find a good idea, we'll short sell it or we'll add it to the portfolio, then we'll go home, put our feet up, come back in a year's time, cross our fingers and hope that we've made money. We're really looking for evidence along that journey, whether we're seeing it in the numbers or it's qualitative, as to whether or not we can gain increased conviction in the position and add to the position, as we have done with this company. And then probably just the last point, to try and highlight why we're looking for leverage balance sheets and earnings risk as a real bread and butter type short. You can see that we've sold the stock somewhere around the $20 level, but also had the view and the actions view that it was a good sell at $9. And the interesting point to make there is the company actually traded on a very similar multiple at both of those points, despite the share price halving. And that's a function of, as I mentioned, that declining earnings profile and also the effect that the financial leverage has. So hopefully that's a bit of a feel for what we're looking for in the short book. And it's probably also a good point for me to pause and hand over to Chris.
Thanks, Josh. And from a bad news story to what we hope is a better news story, I'm going to talk about our long-only small-cap focused opportunities fund. And I'm going to start with one of the most common questions we get asked, which is, how is the fund positioned? On this slide, I've broken down the fund into sectors or subsectors, which are hopefully illustrative in terms of what we own. So you can see on this slide, junior telcos, software and services, payments and e-commerce are all well represented subsectors. And we like these because they all have what we consider to be defensive or durable growth characteristics. What do we mean by that? We mean these are all companies and sectors that will have good 3 to 5 year and hopefully beyond demand drivers, which means that their revenues will grow well in excess of the market, whilst at the same time, you know, if and when we do run into a downturn or a recession, these are all companies that have enough demand or that will mean that those businesses and sectors are not cyclical, not tied to GDP growth, but will be somewhat less sensitive to any downturn. I think what's just as important as what you can see on this slide is what you can't see. You know, risk management is as much about what you don't do as what you do. And for me, I think it's worth pointing out, we haven't rotated the portfolio from growth to value. We haven't jumped on any what I'd call flavor of the month trades recently. So an example would be back in July, it was all about iron ore. Iron ore was hitting all-time highs. We had zero iron ore. More recently, battery minerals, lithium has gone on a hell of a run. We haven't participated there. And likewise, uranium is very popular at the moment. We haven't played. The reason for that is, even though you can make a lot of money very quickly if you're right, chasing thematics, you have to be doubly smart. You have to nail the timing on the entry, and then you have to be smart to nail the exit to capture those profits as well. And I can tell you we're rarely accused of being too smart. So if we move on to the next slide, you can see what we've been up to lately. So on the left-hand side, we've got Codan, Pushpay and Elders, all businesses we have exited or reduced recently, and use the funding, use the capital to increase weights or introduce new stocks like Hansen Technologies, Aussie Broadband, and a recent IPO, Trajan. The thing that struck me when I was putting together this slide is that the businesses we've sold or reduced are all, there's nothing wrong with them really. They're all high quality companies. They're all good businesses that generate good returns on capital and lots of cash flow. It's just that right now we're in the fortunate position of selling good businesses for what we think are better ones. So, you know, part of that is philosophical. You know, we have a view that you want to have a relatively tight portfolio in terms of position numbers. Right now it's 30. We own 30 stocks. We don't want to have a Noah's Ark portfolio where we own 2 of everything. So if we move on to the next slide, I'm just going to talk about our stock story for today. So that's Unity Group. I've chosen Unity because it's our largest holding. I also think it illustrates the process we use reasonably well in terms of the financial maths that Tony talked about earlier, and also defensive growth elements. So what does Unity do? Unity competes with NBN Co. They lay wholesale fibre past new home estates and into new apartment buildings. The small cap market in Australia has had a long and profitable history with fibre assets going back to businesses like Amcom and Vocus. The market loves these assets because it's an essential service, but also the incremental returns on capital and the incremental margin as you add a customer onto a network with very low incremental costs means that that incremental margin is very high, as is the cash flow and return on capital. What pushes Unity over the top and makes it an even better business are two things. One is that the capital is actually funded in whole or largely by their customers. So the developers pay for Unity to install the fibre, and then Unity owns that fibre, which they wholesale to internet service providers like Aussie Broadband, which we also own. The other reason it's unique is that it has very high embedded growth. So you've got an infrastructure-like earning stream, but unlike many infrastructure assets, which are very relatively low growth, Unity from just customers already won, we think they can double or triple their earnings over the next 3 to 5 years. So for us, that defensive quality plus the growth makes it a compelling idea. Moving on to the next slide, I'm not going to dwell too long on the stock-specific names here. This is our top 5. The thing I would point out, all very different businesses, from Unity we've spoken about, to Tyro, which is point of sale, merchant acceptance, Johns Lyng, a industrial services business, City Chic, plus size women's fashion, and Hansen is enterprise software. All very different businesses. So where's the commonality? The commonality is around the financial maths. So high or improving returns on capital, very good balance sheets, or rapidly deleveraging in the case of Unity and Hansen, very good prospects for growth. And we think pricing is fair with some optionality in all of these businesses around how management use capital. So I've raced through that slide. I've done so because I'm conscious we've got some questions lined up. So I might throw back to you, James, for questions.
All right, thanks, Chris. And thanks, ladies and gentlemen. I can see we have a number of questions submitted online. We did receive a question ahead of time, Tony, and a few people joined the webinar late. So maybe you could just touch on those comments around your thoughts on the management of the size of the portfolio going forward. That's a question for you from David. Tony, you just need to unmute yourself.
Okay, sorry about that. Hopefully that's better. Thanks, David, for the question. Yes, there are a few things that we can do. So a couple of points to make. We had one mandate outside the Opportunities Fund. We are in the process of handing that back as we speak. And that'll be a process that'll benefit both parties over the course of the next 6 months. A few other things to note. The distributions to date have been relatively low. That's because as we've reduced turnover, we've increased or embedded a lot of unrealised gains in the fund. We think that will increase substantially. You'd expect that to increase over coming years, and that's one option or lever we can have is a cash-only distribution. So that will release a material amount of funds under management. But we haven't got to the point of hard close yet. hence my point that we have managed inflows. They haven't increased significantly at all, and there's some levers that we're pulling at the moment. Some we can do. So we'll have to see how that plays out over the course of the next 12 months or so.
Okay. Thanks, Tony. Question from James: what is the overlap of long investments in the long short fund and stocks in the opportunities fund?
Yeah, I'll take that one, James. We aim for about 50% overlap in the long book. Obviously, no overlap on the short side, but so the answer 50%. Obviously, the long short fund benefiting from access to mid cap and large cap ideas and no liquidity constraints. It's a $120 million fund, so it's hurdles of capacity and can execute on ideas very quickly.
Chris, another question, which I think will be for you, was just on Unity Group. Are you concerned about recent insider trading claims?
We've spoken to the chairman about that. The board's view was that that director who was alleged to have sold stock prior to a failed takeover bid for Vocus in June 2013, the view was that the board took was that director was allowed the presumption of innocence. It was something that happened that was unrelated to his duties as a Unity director. We've expressed, as the largest institutional shareholder, we've expressed our support for the board's position on that and believe it has no earnings or operational impact on Unity. So that's our position.
Okay. Question from Arthur for Tony. Tony, what impact do you think what is happening with Evergrande or Chinese property developers will have on Australia?
Yeah, great question. And the reality is it's very hard to assess. Few comments. Obviously, it's a significant impact internally on China, given the amount of GDP comes from property and construction. What we're seeing at this stage, we don't see a significant global knock-on impact other than, perhaps from Australian perspective, certainly iron ore prices, it's not going to be helpful for short term. But our view on this is really not going to be any better or any worse than you get from anywhere else. From our point of view, on our portfolio coverage, we don't have any extractive industries exposure other than indirectly related through a stock like Index. So we don't see it as a significant impact on our portfolio.
Okay. A couple of questions just on the product offering. We'll try and hit them off in one go. Which funds are currently open from QVG? Is there any intention to raise a LIC? And a third question, have you thought about going global with a global fund?
Yeah, look, I can take that on board. Cover off on the LIC first and foremost. I just answered a question on capacity and some things we're doing to manage our capacity. So adding an LIC into the mix with a pure overlap on the strategy probably doesn't make a lot of sense. And then there's the more specific issues in terms of managing, the valuation to an NTA to make sure investors aren't disadvantaged, which has been an issue for a lot of LIC funds. So that is not on the horizon, definitely. In terms of global, I can categorically say that it's not on the table in the short term. What I would also say, it is a path where it would suit our process, but not have any overlap, obviously, in terms of capacity issues from an ASX point of view. So it's certainly something that we could consider in the future. But, to do that, it would have to be the right investment team. And there's a lot of other things to cross as well. So it's not on the immediate horizon. And what was the third part? Sorry.
Which fund is open?
Which fund's open?
Oh, yeah. Well, we're soft close, only open to existing investors on the opportunities fund. So it's, but very much a long runway still ahead for long short. We're currently at around 110 million or so in that product. it's hard to assess where capacity is, but we certainly believe that it could be at a similar level over time to where we are in opportunities fund. There's still plenty of runway ahead.
Okay, thank you. A question from Matthew Horton. You flagged you'll continue to hold Square. Thoughts on the Bitcoin, the BTC holdings?
Josh, do you want to take that one?
Yeah, sure. I mean, obviously it adds some level of volatility into the earnings, and those you would value differently to what you'd call longer term, more stable earning streams within the business. But I mean, that's only talking about near-term earnings, and you can't get anywhere near the current share price if all you're doing is looking at near-term returns on the stock. The way I think about the Bitcoin offering with Square is more just about their rapid product development and giving the customer what they want. So let's use Cash App to get them into the core functionality of Cash App to get them into the ecosystem, which is the peer-to-peer transfers, and has been very popular even against the incumbent Venmo. But then beyond that, let's just rapidly give them everything else that they could possibly need: share trading, Bitcoin trading. So it's certainly not a core part of the thesis. It's probably the most concise way I'd put it.
Thanks, Josh. A question from James. Does the BGH bid withdrawal from Hansen not raise concern?
Yeah, I can answer that one. No, I mean, this is a stock that we've owned in a prior guise going back a decade or more. We know the business very well, we think, certainly before BGH was in existence. And there was some pressure on the board to not extend the DD to BGH, and quite rightly so, I believe. So whether that was an impact, we won't know for certain. But if you have a look at the recent earnings of Hansen, the organic growth has actually improved. It's a very defensive business in terms of the type of product and service that it operates in, and it's had a very stable management team over many years, and certainly the indications to us is that that's going to continue into the future. So it's worth noting that Hansen has provided a fantastic opportunity for us. Given when you're in a bid process, there's a lot of long-term investors on the register, merger arb and the like, and that has had a short-term impact and provide us a significant opportunity, we think, in terms of where that business should be valued.
Okay. Next question, Tyro, what is the investment thesis? What sets its EFTPOS terminals apart from the retail bank's terminals?
Yeah, I'll take that one, James. So the terminals themselves are a dumb hardware. There's no competitive advantage there. It's really the software that's written on top of the terminals. And in Tyro's case, their big competitive advantage is they have point of sale integrations with over 300 point of sale software vendors. So that seamless integration between the terminal, the software that Tyro writes on top of that terminal and back into the merchant's point of sale software is what gives them, is one of their sources of competitive advantage. Even if you didn't understand that or believe that to be, you can just look at the market share trends, and the big four bank in aggregate aren't taking any share in terms of point of sale, new merchants coming on board. It's groups like Tyro and to a lesser extent SmartPay that are taking share, and you can see that in the numbers. Tyro is growing its even right now through lockdowns is growing gross profit and net revenue at 20+%, and we think they can do 25 to 30% gross profit or net revenue growth for the foreseeable future. So very optimistic around the numbers that business can do on reopening, and then with a longer term view as well.
Okay, thanks. Quite a few questions still coming through, gents, so we'll keep pushing on. How are you guys thinking about Australian housing market, and are you guys playing stocks in this space, if any?
Yeah, I can take that one. The answer is no, primarily because we can't find any stocks in that space that actually meet our return on capital and durable compound earnings growth cycle benefits. I mean, these are typically cyclical businesses, and hopefully it came through loud and clear that we're not about chasing short-term trends in the market. Clearly, with record low interest rates, buoyant property prices, and coming out of lockdown, you would expect the housing market to be quite buoyant. I guess you could say we indirectly play that through Unity Group, which rolls out telco infrastructure to new housing estates. So in that sense, we play it, but we're not in there just because of short-term cyclicality with Unity.
Okay, thanks, Tony. A question on the Opportunities Fund and the healthcare exposure at 8%. Can Chris speak about this and why it's not higher given recurrent earnings defense and the defensive nature of the industry?
That's a really good observation, and it's a question I've asked myself over the years. Why haven't we owned more healthcare given the long-term demographic tailwinds behind the sector? And I think the answer is that the best healthcare companies in Australia have been mid-caps or large caps for a very long time. So if you think about CSL, Cochlear, we might have caught ResMed in the very early days, but for the most part, the global leading healthcare stocks are mid-caps and large caps and have been for a very long time. So you've got to go down and look at our X100 universe and have a look at the healthcare in there. And a lot of what's classed as healthcare is really biotech. So, really doesn't meet our criteria largely around the risks inherent in those business models. But it's certainly from a high level, it's a sector that we should like more. But as Tony described with his answer around building and housing stocks, the business model and the fundamentals of the business are the overwhelming driver of our decisions. So if we can't find the stocks that express the theme or represent the sector, then we're just not going to play.
Okay. A question from Henry: does the Opportunities Fund only buy stocks outside the ASX top 300?
No. Sorry, yeah, I can answer that. No, I mean our universe, the small cap definition is typically X100. So our sweet spots in that 1 to 300 space, along with many others. One thing, being a standalone fund with no large cap funds sort of sitting above us, we can make logical decisions around our exit point in terms of stocks that go into an ASX 100. So we have over time had a handful of stocks which have graduated into the ASX 100, and we'll continue to own those while if it makes logical sense to do so. But we are first and foremost a small cap stock picker, and the generation or inception of the idea will be in that X100 space. One thing that we have done well, we think, is play that process of finding really good quality business ideas outside that ASX 300 space and take advantage of that graduation process through the ASX 300 to the 200 and as I mentioned, in some cases, the 100, which means the investment universe or demand for that stock continually grows significantly over time and pushes that multiple up. And so we're cognizant of that. And while ever the business fundamentals makes sense for us to continue to hold and take advantage of that graduation process, we'll continue to do so.
Okay, thanks, Tony. How do you think about the timing element in shorting? Do you look for catalysts before initiating a short position?
Josh?
Yeah, absolutely we do. I mean, if you speak to most people who are short and say, what's the key difference? And the answer more often than not will be a catalyst. It's especially important if you're shorting a stock based on valuation, which is probably the weakest thesis that we have and the least common thesis. But certainly if valuation is the thesis, then you absolutely need a catalyst. The flip side to that, though, is there's plenty of ideas where it really ticks enough boxes and there's enough smoke that you know that eventually something is going to have to come through in the numbers, but it's difficult to put your finger on in terms of timing, and you just have to be there. And at the risk of sounding like a broken record, that sort of ties into the point around leveraged balance sheets that I was making earlier. So if you've got a business that is stressed from an earnings perspective and a balance sheet perspective, to a large extent, you don't need that catalyst because it's on its way. You don't have to pick the timing exactly because that business can't repair its own balance sheet by itself. And there's a few ways that can happen, but I mean, the most obvious is it's going to have to come to market and raise equity. And the reason that having that on the horizon makes for a more lucrative short is eventually people will catch on to this idea. The market will see that business needs capital. They're going to have to issue shares, which is dilutive to shareholders and destructive to returns. So quite often you'll see a buyer's strike where people move away from buying that stock thinking, oh, look, we'll just buy it once the balance sheet is fixed up. And that raise has to happen at a discount. So you often end up with a discount coming into the raise and then a discount for the raise. So just bringing it back to the catalyst question, the answer is yes, in general, we need a catalyst most of the time. But wherever we can, we'll find those stressed businesses where even if we can't predict the catalyst, we know it's soon.
Okay, I'm just conscious of time, folks. We've got about 7 or so minutes due till we wrap things up. We'll get through a couple more questions, but the team have committed to answering all questions that don't get addressed on the webinar via email, but we'll push on with a few more. And if the QVG guys could try and knock them over so we can get through a few more, that'd be great. Thoughts around a catalyst for people infrastructure, PPE?
Yep, I'll take that one. There's two catalysts. One is a return of elective surgeries, which would help their nursing business, and the second would be deploying some of their balance sheet. So they've got plenty of liquidity and headroom to acquire further businesses.
Okay, next question. Why the absence of resources in the portfolio, given your expertise in the area and their tendency to outperform during inflationary periods?
Yeah, I can take that one on board. Again, it comes back to the metrics that we look for. So if you look at the bulk of extractive industries businesses listed on the ASX, they don't go anywhere near meeting those financial metrics that we look for in a business. There are a few that do. And then a big part of the equation becomes a top-down equation in terms of supply and demand of the particular commodity, and that makes it a very cyclical bet. So on that basis, particularly as we get larger in fund size and we have to hold stocks for longer periods of time, it makes it less relevant to buy an extractive industry stock. Having said that, there is a stock that does meet our metrics that is very much related to the industry. Is a stock called Index, which has significant intellectual property. We like the strategy and where the new management team is going with that business, and we continue to hold that particular company.
Thanks, Tony. What was your feeling overall in August re company outlook statements for the universe you invest in? Increasing costs more than transitory?
Yeah, I'll take that one. The outlook statements, part of the question, well, companies won't really, COVID gives everyone a free pass not to say anything. So I think this year AGM season will be even more important. So late October through November will be another mini reporting season, as companies will be forced to say something about trading. The view on whether inflation is transitory or more permanent, that's macro crystal ball gazing that we don't have a strong view. If I had to guess, the world will look very different in 12 months' time, and a lot of the supply chain issues will be sorted, but inflation has persisted longer than perhaps many thought.
Thanks, Chris. Do you see risk that Afterpay might be re-rated as a finance company or face regulatory constraints for the same reason?
Yeah, I'll take that one. I think big picture point to make about Afterpay is if you own Afterpay, you really own 20%. You really own Square, and Afterpay is now 20% of Square. So the questions you should be asking yourself are more around Square. Any issues with Afterpay are diluted by the greater group. With regard to derating, a derating as a consequence of it being a finance company, I mean, that has been an argument ever since Afterpay first came to prominence. It hasn't hurt the stock yet, and it won't until growth slows. And the second part of the question was around regulatory risk, I believe. Again, massively diversified business now, so regulatory risk in any one jurisdiction is somewhat mitigated. A better question would be, what gave us confidence to own Afterpay despite that regulatory risk prior to the Square takeover? And very quickly, the answer to that was we'd seen with disruptive businesses like Uber and Airbnb that as long as there was a high degree of customer support and they were doing the right things by customers, eventually regulators would come to the party. So Uber was banned in London, Airbnb was banned in New York and had the hotel lobby working against them, but customers really loved the service. And both those companies are very customer friendly, as is and was Afterpay. So we reasoned by analogy that eventually that regulators would get on board.
Okay, thanks, Chris. Listen, folks, we really are at time on the webinar. There's quite a few questions that are still open, so I'm going to have to pass those questions to the team, and they've committed to responding, via email. Thanks for jumping on. I'm just going to pass it over to Chris and the team to make some final comments on the webinar.
Yeah, thanks, James, and thanks for everyone for dialing in. We appreciate your time is valuable, and hopefully you've learned something today. If I leave you with one message, it's really our crystal ball is no better than anyone else's. We don't know what the future holds. The future is always uncertain, but hopefully you've got a sense today that whatever uncertainties are thrown at us and whatever volatility there is in the market, that we have a robust and proven process that can handle those challenges. So with that, thanks for your time.